Well, welcome to the Wisdom of Wealth podcast. If you are just hopping in with us, we are actually in the third week of a series that includes video. So I would strongly suggest that you find the link in the show notes and check out this video on YouTube to be able to follow along with the spreadsheets that we will be referencing throughout this video. It'd be pretty difficult to follow it if you only had the audio. Today, as we mentioned last week, Ryan and I have a special guest on the show. Ryan, would you introduce our guest to our audience?
Yeah, this is exciting. So, our guest this week is another member of our team here at Unbridled Wealth, who his background is more in business consulting and particularly in the agricultural space. And he has been structuring some policies and these applications in ways that I actually haven't yet. And that's why we thought it would be cool to show this. So, Joe Burgess is our guest this week, and he's got his hands in a lot of pots. He's got an amazing skill set on multiple levels. And when he understood the value of how this infinite banking concept works using cash value from a life insurance policy to fund business deals, he really hit the ground running. And so last week we talked about how you could use it for investments, and we went through that whole model. This week is going to be showing what Joe is actually doing in real life with one of his businesses. And what's different about this is that the policy is actually owned by the company itself. So this is called company owned life insurance, or COLI. And there's all kinds of ways you can structure it. In the last week, we showed a client of mine who was a personally owned policy he was using to deploy capital into real estate investments. In this week, Joe's going to share with us using the policy to actually deploy into the business itself, and that's owned by the company. So, Joe, welcome to the show. It is great to have you on.
Awesome. Thanks, Ryan. Thanks, Kyle. Super excited to be here. It's been a long time coming, so it's great.
Absolutely. So, do you want to give us any other commentary or background before we just jump into the numbers here?
Yeah. No, I'd love to. So again, because that's really most critical is what are we trying to accomplish with this? And so just to give a little bit, this is based on a orchard project, and so it would be helpful probably just to know a little bit of how the mechanics of an orchard works. So we're specifically growing almonds in this case, and the lifespan of an almond tree is 25 years or can be up to 30 years. And so when we are looking at this as an investment chunk, we're basically looking in a 30-year chunk. And so that's where it's going to be a little bit different than some of your other investment projects. So essentially, what we do is we gather a bunch of limited partners to invest money in. So at this specific project right here, we raised about 1.5 million, and we gather that, and then we go lease a big chunk of dirt. So this was about 155 acres that we leased for this project. And again, we kind of pull all the expenses up front to grow those trees out for the first 4 years. And so to understand, we'll put the trees in the ground, we get our first harvest. So there's really no cash flow year 1, 2, 3, or 4. And year 5 is really where we see that significant cash flow come in, as those trees are then in almost full production, but basically in money making production. And then we start running from there. So any specific questions in that, or
I think that that's where, if you're looking here on the video at column F, you see that there's that $0 for the first 4 years. I'm assuming, Joe, that's because you're not generating cash flows from the orchard deal, and that's why you're not showing it coming back in. And to just add a little bit more background to what you're looking at here, again, starting on the left side, you got the year. So year 1, they're putting 150,000 of premium into the policy. And in that, at the end of that year, the cash value on the illustration is going to be 132,000. And then you can borrow 95% of that cash value to put into the deal. So that's that 127,000 or so. And then in this case, we're assuming an annual interest rate on the policy loan of 4.5%. And as we talked about last time, what's not shown on here and what we didn't show last time, and we'll probably do that in a future episode, is the tax advantages, which are significant, right? Because that cash value growth in the policy, if it's structured correctly, as it is here as a non-MEC, then that policy growth is tax-free. And then if you're borrowing from the policy, that 4.5% interest, which in that column E is, the 5,700, then 12,000, that interest starts to add up, but you're getting a tax deduction if that's used for a qualified business trade or activity, which in this case it would be. And that's generally your highest and best interest deduction. So you're getting a deduction, which is not shown here. What's also not shown is the tax-free growth of the policy in tax equivalent terms. And that can add up to quite a bit. And then, of course, we've got the death benefit over on the right, column H, which is over 6 million to start with. That's good because in a lot of these things, having key man insurance for the corporation and or the limited partner investors is important. And so that's one thing that I've been thinking a lot more about in this private placement space with people like Joe and other syndicators who are raising capital. It really is almost more like you want to bet on the jockey even more than the horse in some cases, because it's critical you have a really solid sponsor, operator, general partner. And so in this case, Joe is obviously a really good jockey, a little tall for a jockey, but he's good. We're going to assume that you have a good, well-balanced center of gravity here. So that's, I think, important, Joe. And I don't know if you have any other follow-up comments to that.
No, I would say, to not veer off too much, but I would say the jockey in 9 times out of 10 is the most critical thing to invest in. And in this case, I'm not actually the insured. This is the lead on the project that's the insured in this situation. So again, we put the money on him. He's the most critical to the success of this endeavor. And I think it's so important. I mean, I'm in a lot of different businesses, and that's really the biggest key between a successful and non-successful business is the jockey, is the people that are in it, way more than their ability to get into a market or an opportunity, is who's actually doing it. Because people, passionate people can make stuff happen when the market says it can't. And, unpassionate people can let stuff fall apart, even if the market says it shouldn't. So, yeah.
And speaking of markets falling apart, it's kind of a timely conversation. We kind of hit on this before we recorded. If you're listening to this right now, we're recording this on March 15th of 2023. And for anybody who's been following the news, there's been a number of pretty big shakings to the banking and financial industry. And so having a really solid uncorrelated investment, in this case, almonds, that really isn't going to have too much bearing on what's happening with, the S&P 500. I would say a critical aspect to this too is the fact that you are putting your money, in this case, into a very conservative, strong financial institution. And we talked about this last time at the end of the previous episode, is that unlike a bank like, SVB, Silicon Valley Bank, and several others, just today, Credit Suisse had some problems. And so when you're putting your money into a long time, well-established, financially strong and conservative mutual carrier who has been paying dividends for, hopefully hundreds of years, then your capital in your bank account is a lot safer than if you were in a speculative financial institution where you're not sure if you can actually get that money out. So there's multiple layers of risk mitigation and contingency planning built in. And Joe, I'm curious, for the death benefit on this one, since it's company owned, does that death benefit, unlike a personal policy like we talked about last time, where it's, the typical thing most people are familiar with, where if the insured dies, their, wife and kids or their dependents, whoever, are going to get that payout. How did you structure it, and how can that be used to a business owner's advantage, and also importantly to a limited partner or passive investor's advantage in a structure like this?
Yeah, absolutely. So it basically goes back to the buy-sell agreement, and that's a really critical piece in setting up any company. And so this death benefit is really the funding vehicle for the buy-sell. So essentially, the way it's set up, at least in this specific, is if the insured or one of the key people, which the insured in this case is one of the general partners of the business. So there's 2 general partners, and then there's some redundancy there, meaning that one of the general partners can continue to function even if the other something was to happen to him. But then this death benefit essentially is going to fund out the buy-sell agreement. So if something happens to the insured, he passes away, that $6 million goes directly back into the company and then is basically used to buy all the limited partners out of the endeavor, and then the business is to be sold after that. So that's kind
Wow.
of the way that it's basically meant to just unravel upon this, the insured's death.
So that's great. So you're protecting the company itself. And what I think is critical that you just touched on is you're also protecting the limited partner investors who are not part of the business other than having put up the capital and getting a passive return. That's, I think, a really important aspect as you're taking risk in these kinds of private market opportunities. You're making a pretty significant bet on one specific operator, one deal, a certain model. And again, that's mitigated if you have a really high quality team like you guys do here. But again, just God forbid if something happened to that person, that is another level of risk mitigation that is a question I'm starting to ask now as I'm looking into private placements and syndication deals myself as an investor is, do you have key man insurance? Because again, like you said, Joe, you could have the best structure in the world, but if that critical person, that key man or woman,
If the jockey falls off the horse,
falls off the horse and breaks their neck, the horse is just might be running around wild, bumping into walls or running the wrong way. Who knows what's going to happen? So that is a really important aspect that I think is, again, why we wanted to have Joe on this week, because this is a different structure than we talked about last time. And, you can do a combination of many different things, but I think that in itself, that death benefit, which we kind of don't really give a whole lot of attention to, is really, really important in a situation like this. So you've got a $6 million plus death benefit to start with, which again is tax-free and distributed if something were to happen. But other than that, I think, again, we're really focusing on more the cash value, the liquidity, and how much excess return this policy is generating. And I know, Joe, we had talked earlier, it's a bridge too far and it's beyond the scope of this interview to show all the details of the pro forma of the investment return itself, but it was pretty compelling. Yeah. I mean, you're talking about conservatively anywhere from 15 to 25% net IRR to investors after that, 20 or 30-year period. So that's all going to be in addition to everything we're showing. And and correct me if I'm wrong, Joe, what you're showing here is just the excess return of the policy itself, right?
Absolutely. Yeah. And again, I guess one last thing on the death benefit. Essentially, if something happened within those first 5 years, you're going to get a 4x return on your investment. We raised 1.5 million and it's going to give 6 million back into the company. So I don't know many investors that would be really tragically affected by a 4x return on their money in 1 or 2 years.
Yeah,
right?
We're not hoping anything bad to happen to the jockey, but
we're not.
That is a significant return. Yeah.
But we have options, right? And we may
Right.
all decide, hey, we're all friends. We love this. We've got $6 million. Let's hire a new jockey. And you keep on running. But this gives us it gives us flexibility and gives us options. And so that's just, it's huge. And like you say, we don't necessarily talk enough about it, but it really is, because it seems like it's forever out there, but it really isn't.
Right.
So
why don't you walk us through, you talked about how, the again, this, just like everything we talk about, this is all a long-term play, right? It's not a get rich quick scheme. As you can see, you're going to be slightly behind that first year. You put in 150, you've got 132,000 in cash value and about 127,000 that's available immediately to borrow. So you're a little bit behind, and then the orchards themselves are not really producing a financial return until year 5. So you're kind of, again, you're capitalizing your banking system, you're investing in the deal itself, and you've got, in this case, a patient investor is going to get paid very well, but it is important to understand that you're not going to really have any positive net cash flows other than if something horrible happened and with that death benefit payout. But assuming all goes well, you're going to be a little bit behind for those first 4 years. But talk us through the rest of this return profile where things really start to get interesting here in year 5.
Yeah, totally. And I guess just one thing to mention in this, I know this may be kind of unfamiliar for most people that aren't familiar with investing in ag, but the concept of basically putting all your money in and just letting it sit there for 4 or 5 years is very normal. Like that's just the business model. So the idea of, I know a lot of people kind of hesitate, like, man, that's a lot of money to put up and just sit. But that just is reality of what it is. So it just takes time for a permanent product orchard to really kind of grow into maturity. And so
that's a good point. I just want to hit on real quick, Joe,
Yeah.
is that, would you say it's fair to assume that anybody who's involved with this project, whether the GPs or the LPs, the investors, that they're probably, again, like we talked about last episode, they're starting off in a really good position financially, strong cash flow, strong liquidity, where they aren't depending on the policy or the investment to be paying their monthly expenses.
Yeah, no, not at all. Not at all. No,
Right. So that's just
all these
pure
are really,
excess.
yeah. Yeah, as far as what the investor is putting in, totally. Yeah, that's money they don't need to see back for 5 years.
Right. So that's important. And again, patience pays off in this case. And I think that, structuring, coming back to the financial planning element of things, this is great for a long-term play that I think has some really important diversification aspects. When you're talking about agricultural and a potentially non-correlated or inversely correlated investment, which just means that it doesn't depend on the ups and downs of the traditional asset markets. But you can also start to supplement that with, if you did need some cash flow, there are some other deals that I'm investing in that give really strong cash flows. They're a shorter period, so it's kind of the opposite. But if you match that up, where you're getting good cash flow at the beginning and then it's kind of done after 7 years or something, then this one comes in, and that could be, a diversification aspect to your capital deployment strategy. And so, again, can't emphasize enough the importance of really good financial planning and strategy on the front end to make all this work, because we don't do this stuff in a vacuum. But again, without going, off on a bunch of rabbit trails, having established that these people are all okay with waiting 5 years to see any kind of return, then it starts to get pretty compelling, as we can see here. So why don't you walk us through what we're seeing on the screen here?
Yeah. So one of the most important things to consider in this scenario is that I am using cash flow to fund this policy, meaning that, like you said, 150 grand goes in year one, and I'm going to borrow 126 of that, meaning whatever the available cash value is, we're taking the max loan on it because I want to pull that money back out and put it to work. So this money is getting spent on just normal, ordinary upkeep and cultural costs of the orchard. And so that's probably one of the things that's really different about this scenario versus some others where I'm just setting kind of my excess or my net, kind of my bucket over there for a rainy day. This is very much, we're hustling this policy as hard as it'll move. So that's why
And
we're
that's
basically
important too, Joe. I think that's a great point you just brought up, because a lot of people feel like they're like, oh, I don't want to start borrowing. And it's like, look, don't borrow if you're not going to get a return or some kind of tax deduction. Like, you can do that, but really infinite banking is meant to be used to generate wealth on a net basis. So, but if that's the case, like we have here, that's what this is for, right? Don't hesitate to use full advantage of that cash value. And that's what you're showing here. You're borrowing max loans every single time. And that's, I think, Joe, if I got these numbers correct, that 4.5% APR on the interest times the 127,000 or so, that's what equals the 5,700 in interest, right? And then
correct.
that's just so on and so forth for the rest of those columns.
Yep. Yeah. And again, I will caution, like with this specific business model, we don't need the kind of the safety bucket. We've got that in another vehicle, in another mechanism in this situation.
Right.
And so, in our other businesses, we've got about 18 different policy structures within our business network like this of similar size, and they're all different structured. They're all kind of for different intentions, different purposes. So I'm totally comfortable keeping this policy maxed out and having zero that I can go borrow against, because that's just how this one is designed to function. So just want to make that clarity, because this could feel a little reckless if this was, it would just depend on, it really depends on the business scenario, the cash flow model, and what you need it to be, right? So
Yeah.
just want to make sure I clarify that.
Joe, what percentage of the cash flow that you guys are using operationally are you running through this policy?
Really good question. So at this point, we raised 1.5 million out the gate. We spend about 600 grand of that right away, and then I've got about 500,000 in cash sitting in the bank, and so it's going to be right about 25 to 30% of our cash flow for those first 5 years, and then it drops down to the base, which we can talk through that in a second. But yeah, it's about 20 to 25% those first 5 years.
Great.
Yeah, great
Thanks.
question, Kyle. And I appreciate your explanation previously, Joe, that, yeah, again, we're not doing this in a vacuum. That comes back to what we talked about, the holistic planning and strategy. And there's a lot more that is not shown on this spreadsheet. And again, we we want to make things manageable to understand, but please understand that there's I sat down and I looked at this spreadsheet with Joe, and just like I told you guys in the last episode, if you were to see the spreadsheets behind the scenes that we're not showing with the level of planning, analysis, stress testing, etc. I mean, it's overwhelming if you don't know what that is. That's why we're not showing it. But please do understand that, like Joe said, they've got contingencies, they've got 500K of cash, they've got 18 different policies. And as Kyle said, it's important to understand how much you're putting in, because at every point, Kyle and I had an early episode, we talked about margin of safety and how important that is. And so that's, you want to be conservatively structured. And again, it's just hard to show all the nuances of that. But I think those are some really important caveats, because otherwise, you're right, Joe. People are like, man, you sure are leveraging yourself pretty heavily. What if the cash flows from the business don't come in? Like, you've got multiple levels of risk mitigation built in that's, beyond the scope of the spreadsheet. So I think those are really good caveats and kind of background for, what we're looking at here.
Yeah, absolutely. And I guess one thing to note, about 35% of annual revenue, that's the max you can actually physically run through a policy with the carrier we tend to use. So yeah, just to note that, right? So we're not quite at that max, but we're close on this specific project because of its cash flow.
Yeah, that's a good point. There's a different formula for how to determine coverage limits and premiums and all that stuff, which is, again, beyond the scope of this episode. It's different when you're looking at a personally owned policy versus a company owned policy. And those are important, again, front end strategy and planning considerations. But to just review, you're raising 1.5 million in this deal from the equity or limited partners. And of that 1.5 million, you're putting 150,000 of that. So basically 10% of the raise is going into the deal. And then you immediately spent 600K in year one, of which 126 is coming from the policy. Is that correct?
Yeah, that's correct.
Okay, beautiful.
Yeah, so again, that still leaves a big chunk of cash in the bank. And so over those first 4 or 5 years, we're going to put about 750. So almost 50% of our initial raise we'll put through the policy. And again, we're not doing that all at once. We're doing that kind of staggered year over year. So again,
okay, I think that was maybe I didn't understand that. That's so you have the 150 from the raise, and then you still got the 500 in the bank. Back to Kyle's question, which is a really good one, is you're funding these ongoing premiums of 150 for that first 5 years. Part of that, or I'd say probably most of it, is being funded from the 500K that's just sitting in the bank account to start with.
Initially, but again, it's cash flow, right? So even though I'm so the model of this, we spend 100, all of 1.5 million we'll spend in the first 5 years,
right?
And so that's why the numbers don't line up, because again, I'm taking some of that 600K that we spent and I put it into the policy, and then I immediately borrow it back out, meaning technically I've only lost access to about 20,000 in that first year transition. And then the next year, it's only lose access about 10 grand. And then it really starts to get smaller really quickly, right? As far as the amount of money that I have access to.
And I think that has to do with the difference in how you structured this policy versus what we typically do and what I showed in the last one. Usually we do 80% paid up addition, 20% base premium, which we talked about in previous episodes. Joe, because of the way that they need even higher access to liquidity, you're structuring this differently, where you're actually doing about a 90% allocation to the paid up addition and 10% to the base, which is why you see after year 5, it goes from 150 down to 15,000. So that's correct. Another thing that you're getting an extreme efficiency to the policy design in those early years. It's a trade-off, and which is, again, too much to go into at this point, but in this particular context, this particular context, that's important because you want to have as much liquidity as you possibly can to put into the project itself. And so that's, I think, another important thing to note about this is, if you go back to our first episode in this series, we talked about how the difference of the base versus the PUA, the paid up addition is kind of the cash value supercharger. And so depending on your situation, even that structure, there's not a one size fits all. Like, you should always do 80-20 or 90-10 or 60-40 or whatever it is. It really depends on the situation. So as you guys Absolutely. Can see, over and over, we keep hitting on these episodes. It's not enough to be really good at structuring the policies themselves, although that's a non-negotiable critical aspect. I'd say it's even more important to look at the bigger picture of what makes sense in that particular situation. And that's how you've structured this one. That's a different kind of setup than what we talked about last time.
Yeah, no, that's so well said. Yeah, Ryan, it's so critical to work with a good strategist that really has an idea, and then you just bang the numbers back and forth until you find the sweet spot. And so, I would brand this as a really efficient policy. You can see those first 5 years, we put 750,000 into the policy, and we've got access. You can see in that column C, access to our cash value is at 742. And so I think that's really good. And again, like you say, that's what we want is access to cash is critical. Early access to cash is critical in this scenario. So
yeah, and this
uh,
policy, this product specifically that we're using with a particular carrier is specifically designed for maximum guaranteed early cash value access. And
yeah,
that's another aspect is that, depending on the situation, one policy or product might be better than another, not just in general, but for, it's all dependent on the specific use case. So in this case, you might have a policy that gives you a higher non-guaranteed long-term return than what we're showing here. But this policy design and the product specifically is really designed for guaranteed early maximum cash value access. You're not going to have as much on the non-guaranteed dividends in later years. As you can see, the base premium drops down significantly, which limits how much you can continue to put in. But again, those are all trade-off decisions. You have to really be pretty sophisticated and well-educated to understand on multiple levels. So again, I think the color commentary here is really helpful. But with all that said, show us how things are happening after you put in the initial capital raise, you're funding the policy through the money in the bank, and then eventually starting year 5 now, you're starting to put in it looks like some principal repayments, right? So that's where you got those 0 first years because there's no cash flow from the orchard. Starting year 5, the orchard is now kicking off some pretty good cash flow. Why don't you walk us through that?
yeah, totally. So basically what we decided to do in this scenario was basically take 10% of our net from the investment. So and apply that towards paying interest first and the remainder just going after principal. So so this orchard's going to net around 600 grand a year. And so we're just taking 10% of that. So that'd be 60,000. And the reason we're doing that is so it doesn't drastically affect the returns for our investors. We really want to protect that. And then we begin to start paying that principal back down low. Again, we've got flexibility. So if something happens, our crop is down a little bit, well, we only have to pay the interest and the principal is optional. So that's a huge thing for us to have that flexibility. But basically in
Yes.
this scenario, we begin to take that 60 grand and kind of split it. Again, we'll pay 32,000. That's going to be our interest on that $712,000 loan. And one thing you'll notice is this is the loan value grows to 712, and then it begins to come back downhill as we begin to pay that principal back down. And again, now this orchard is in cash flow. It's doing well. It's going to begin to kind of pay itself back off.
So that's good. I just want to hit on that real quick, Joe, because if you're looking at these numbers, at first it seems like they don't add up. And again, you're not seeing outside this spreadsheet the actual cash flows, but that's important to know. By year 5, yeah, you didn't get anything the first 4 years, but now you're saying you've got net cash flows from the investment itself after expenses and everything else of 600,000, which is pretty compelling. And of the 600,000, you're taking 60,000. And if you're seeing how those numbers add up, the 60,000 is the combined total payment. That's 32,000 in interest, and in this case, about 28,000 in principal repayment. Those two columns, E and F, add up to the 60,000, which is the 10% of the 600. And so that's how, if you're looking at these numbers add up. So there's an amortization. That's a great point you just said, Joe, that these are unstructured loans. I can't emphasize enough. Kyle and I talked a while ago about some pretty innovative, lending products for borrowers for homes. And the power of being able to self-amortize your own loan schedule and have total flexibility is so critical, especially if you're a business owner with uncertain cash flows and liquidity. That optionality is huge because it serves two things. Number one, if there's a cash flow crunch, like you said, Joe, the orchard's maybe not throwing off as much net cash flow as you projected. Well, you don't have a fixed rigid payment structure. You can choose to toggle between if, when, and how much principal and interest you repay. And then you can also pay more than that and save on interest. But again, we're using a reasonable expectation and projection here, but those are really, really important points that go into the strategy.
Yeah, no, that's great. And again, yeah, the essentially to follow the math, the column over here in column G, this is basically balance. So this is available money that I can go borrow against again if I need to. And this is essentially, this project was designed to wean itself off of our secondary redundancy nets, kind of funding nets by year 10. And so you can see as we go down to year 10, this is essentially original cash value will be over here in column C. We've got just shy of $1 million. Outstanding loan at that point is down to 560,000, meaning that I've got 380 that I could go borrow again if I needed to, and for by year 10. So I used my secondary kind of backup for those first 10 years, but I know that, hey, at this point, this orchard now is fully self-sustained, stand on its own. It's not a liability for anything else. It's really fully structured by itself. So one thing to note there.
Yeah, great point. And that's where you're seeing the balance of that cash value. That's what we call the net cash value, right? The total
Correct.
cash value minus the outstanding loan. That's how much you would have available to borrow against if you wanted to. And that's why, as you're repaying that loan principal from the policy with the cash flows from the orchard, then you're saving on interest. So you're seeing that annual interest is going down after, looks like, year 5. And that's because you're paying interest on the outstanding balance. So you're improving both your liquidity and your cash flow by paying down that loan with tons of flexibility if you need it. And so it looks like here, Joe, you have entirely paid off the full loan by year 22. Basically, you're pretty much, that's all paid off at this point. You've got now, looks like 1.56 about 1.6 million of net cash value, and you're still putting in, you don't have to, but in this case you modeled out, Joe, it looks like 26 years of base premiums. And then and if you were to do another level of analysis, you'd see that the annual cash flow now, just from the policy, like not even including the orchard, the cash flow from the policy is significant, is many multiples of the premium that you're putting in. And you're not going to be able to see that on this spreadsheet.
It's about 90K. And
yeah,
in column C, you'll see between year 22, 23, that growth in that policy is pretty close to about $90,000.
Yeah, great point. And that's where, again, sometimes it's what you don't see on the illustrations and the things that can be even more important than what you do see. And we're trying to hit a sweet spot of giving you enough information without overwhelming you with like a million lines on a spreadsheet. But that's, yeah. So if you're interested in what that cash value increase is, you're putting about 14,000 of premium in at this point. The loan's paid off. And in that case, if you do that math there, between year 22, you got about 1.83 million of cash value. The next year, you got 1.92. So your cash value increased by about $100,000, and you only put in 14,000 of premium. So that's a pretty good annual return, tax-free, very conservatively, just inside the policy. Not to mention the orchard's still probably producing at this point, right, Joe?
That's the goal, man. Hopefully it's still killing it.
Yeah.
So
yeah,
can
that's
you
amazing.
Joe, can you give us some color around why you switched to the base premiums after year 5? What were some of the major things that were happening? I understand that we're also looking to be as efficient as possible inside this policy, but why are you switching from that 150 in year 5? And then how's that benefiting you? And what are some of the big landmarks that are happening as we go down the spreadsheet?
Yeah, totally. Probably that. So basically, I factored out at year 10, how do I get the greatest return? And I like stacking them heavy, 90-10 at the beginning. And especially with this scenario, you physically can't, with this specific carrier, carry out a 90-10 ratio for the first 10 years. You'll have to drop down. And so that is one thing to note. Typically, you'll have to drop down under to more of an 80-20 ratio starting at year 6 through 10. And so that's part of it, Kyle, is physically you can't fund 90-10 for 10 years.
Is that because of the MEC limit, Joe, or just the carrier specific guidelines?
That's the carrier specific guidelines.
Okay,
Yeah.
so that's good to know because I've never actually seen that before. So that's why we have a variety of different people come on here.
Yeah.
Usually in my clients' cases, what's personally owned, 80/20 is the sweet spot, but that's a good point that 90/10 is great in this case. But the trade-off is obviously you can't put as much in after that 5th year, but that's okay because again, Joe has done an extreme level of analysis and due diligence in how to maximize returns inside both the policy and outside the policy, and you have to look at all of that on a net basis. And so
Yeah.
those are the trade-offs you have to be considering.
Yeah. And so part of the reason we dropped down out 150 and don't continue to do that is we want to make sure we've got the whole goal is by year 30. So I'll just scroll down to year 30 and kind of start at the end, and then we'll work backwards. And then I'll probably explain some of the reasons why we did what we did. So if you look down here at the end of column C, it's not in alignment, but essentially total input into the policy during those 30 years was just over $1 million. And then the total interest we paid back, so this is true cost to the company, is 390 in this situation. That is deductible, just like you said earlier, Ryan. That is an ordinary business expense. We can totally deduct that 390. But essentially, in total, we have just shy of 1.5 million that we put into this policy, and that'd be a combination of that's all principal plus all the interest we paid to have those outstanding loans as long as we did. And then currently, if you look at year 30, total cash value is right at 2.5 million, meaning we've shown an overall gain of $1 million just within policy growth, even after we paid that almost 400,000 in interest payments. And our ultimate goal was we want access based on inflation. It takes $1.5 million to develop this orchard at this point today, but we're projecting inflation wise, we believe it's going to take 2.5 million to do the same project in 30 years. And so our whole goal was we want 2.5 million in cash value by year 30. And so the cool thing is now we can basically redevelop this entire orchard without any additional cash draw from our investors. Wow. So previously we'd all just kind of have a little champagne party and a good time and walk away, right?
Right.
And pull out the checkbook again, like, hey, we loved it. Let's do it again. Pull out your checkbook. Now we basically have a completely self-funded, and not just the 1.5 we originally put in, but actually 2.5. So a little bit better of an inflation hedge to basically go back in and redevelop this. Or if everybody wants out, well, we can buy you back out and you walk away with a lump sum of cash, essentially, of what you brought into this scenario.
Wow. So this is truly a 30-year investment timeline. That's so brilliant, Joe, that you structured it that way. That's where you guys can see that it's so much more than just the policy itself. He had very specific numbers. You're adding in inflation, which obviously is critical. That was kind of a hypothetical until the last 12 to 18 months. But it's a very, very real factor. And so I love that you thought about that. So I just I want to go through the rest of what you've got on here in the next few minutes of what we've got left. But I just want to make a couple comments. Number one, you did pay, like you said, $390,000 of interest in this pro forma. But assuming that I think a reasonable assumption is that if you're in the 30% tax bracket, the corporation, when you add everything all up, if that was all tax deductible, then 30% of that is 117,000, right? So you saved 117,000 on taxes. So that brought your effective borrowing cost from the 390 down to closer to like 275. And then you've got over $1 million of tax-free gains in the policy. So if you take that number, the 1,059,000 and change, then if you plus that up by that same 30%, if we're using that as your assumed tax rate, that would be tax equivalent in a taxable account to about 1.5 million. So now you've got the tax equivalent gain in the policy of 1.5 million plus the 117,000 of tax savings on the interest. What you're showing is a net gain of $1 million there, Joe, on tax adjusted basis. That's closer to 1.6 million in a very conservative vehicle. So that alone, I mean, if you're just looking at inflation, which historically has averaged around 3%, that's probably going to be a lot higher, for a while. So you have certainly hedged against inflation. and all the multiple other risks. And again, that's why it's not just what you see on the illustration or even a more detailed spreadsheet. There's these other factors that are really important to consider. And, for your kind of investors and this kind of business, Joe, taxes, as you know, you're very, very savvy on taxes. We both spend a lot of time thinking and planning around that. That is a really, really important thing that I think it just has not gotten enough press when it's designed and structured properly.
Yeah, totally. No, that's great. Great points, Ryan. Awesome.
So just finish up here with giving us the rest of what those numbers you got down on there.
Yeah, totally. So basically, we illustrated that outright again, the premium. You can see we stopped premium at year 26 in this project. Again, that's based on that 25-year minimum life cycle of a tree. And so we wanted to make sure, okay, when this project's over, we don't want any cash flow to be against this structure. So that's why we cut it off where we did. We can run it out for that other 5 years if everything's going good and all the numbers still work. The really cool thing is now this policy can basically restart. It's owned by the general partners. It's on one of their lives. And so it can just keep on rolling. So we just ran it out to year 50 again. So this would be essentially a project number 2. So again, you don't see the whole back end of the whole orchard performer model, but essentially we get an average of a 25% return on our investment. And so by year 2, again, we haven't put any additional capital into this project. It's still at the 1.4, but by year 50, we're just shy of 6 million we can borrow against, showing a little over $4.5 million gain. By 60, again, this is the really cool thing is it just continues to do it over and over and over again, right? So we could basically run 3 or 2 full orchard cycles by year 60. We've got a little over 10 million in access, meaning we could basically flip out and buy 3 more orchards if we wanted to. So we've seen a little over 7.5 million in gain. The really cool thing is by year 60, the insured, he's doing pretty well, but he's probably getting close to the end of his run. We've got almost $10 million that's going to dump back into this corporation in tax-free gain to all these investors and their children by this point. And that's just one of the most critical things as I look at businesses. We really try to build businesses for generations. And in ag, it's really easy to do because that's just kind of the normal. But this is basically a 3-generation business that this funding vehicle right here is basically 10 million in liquidity. That's just going to keep funding businesses after business. So yeah, love
That's
that part.
amazing. So let me get this straight, Joe. By putting that money into this policy in this first deal, you have basically, because of the gains in the cash value, just by running the money through your banking system instead of paying it out of a checking or savings account, you have now generated, again, not even considering the really, really healthy return of 25% net IRR over 30 years, which is just phenomenal, the compounding that happens. Not even looking at that, just from the policy itself, starting off by overfunding this with just 10% of the capital raise and doing that over that period of the 5 years and then dropping it down significantly, just the gains in the policy are now enough to do 1 or 2 additional deals. And of course, those are going to have their own separate returns that we're not showing here.
Yep.
And by the end of that, you've got a $10 million net tax-free death benefit to keep this generational business model going. And you've now done 2 or 3 deals where you would have only done 1 based on the capital that you ran through the policy.
Absolutely.
That is incredible. I mean, you guys can see why we call this the infinite banking concept, right?
Too good to be true, right?
It really does seem too good to be true. And if you don't do it correctly, because if you guys have seen, we haven't even shown you the beast spreadsheets that have gone into the planning behind this. We're showing you like the high level, and if you have to do this correctly to structure the policies and more importantly, the overall, financial plan and strategy. But if you do it right, I mean, it truly is the hardest thing, I think, for you and I, Joe, because we met at the same conference several years ago when we first got into this. It was almost like the incredulous, like, how could this possibly be real? This seems too good to be true. And then when you look at it and stress test it, it just gets better and better.
Yeah, I would say both, right? It's not perfect. It's not the silver bullet that's just going to cure everything. You still have to have a really good business plan in the background.
Right.
But again, it's such a maximizing strategy that put on when you can layer it into something that's really good, man, it just takes really good and makes it amazing. So,
There's so many good principles to pull out of this episode, and I hope that everybody listening has done so, looking at the delayed gratification as well as just the intentionality to build a plan that is 30 years at least, and then it continues on and supercharges into the 50th and 60th year. I think there's so much wisdom that goes into that, and especially in a culture that is all about having instant gratification. There's a lot to learn from looking through this spreadsheet with you today, Joe, and we appreciate your time so much, as well as we want to honor it. And we just want to thank you for going into the numbers that you put together on the back end to put your business where it's going to be in the future, and allowing those of us to see this that might not have otherwise had the ability to fully understand how this could benefit us in our business.
Yeah, I've learned a ton, Joe. I mean, I know infinite banking pretty well, but the way you're structuring this in terms of a multi-generational business model for investors and the general partners is, I mean, it's phenomenal. So thank you so much, Joe. I learned a ton today. So hopefully the rest of you guys did too. Again, I know this is a lot of information and numbers. Go back, listen to the previous episodes, rewatch it. It takes multiple layers of paint, so to speak, to really start to understand it. But that's what Joe and Kyle and I did. And because we did that, that's why we're doing what we do full time now, because it really is that compelling when we can structure it in light of the bigger picture of the investments and the businesses outside the policy. And Joe, you've done a phenomenal job of breaking that down. So thanks again for your wisdom, your experience, and your time.
Yeah, guys, such a pleasure, dude. Such a pleasure. So appreciate it.
Absolutely.
Well, we appreciate every single one of you that's been listening to this podcast, and we look forward to continuing the conversation next week.